We have Michael Cuggino, President and Portfolio Manager, Pacific Heights Asset Management. He helps manage about $13.5 billion at permanent portfolio funds for medium and long-term market sentiment. Michael, welcome back to the program. So August 2nd, not much sweat from you just yet, right?
Not yet. I mean, that's the date that's been thrown around as a drop-dead date, although, you know, it's not as if the world is going to end on August 2nd. The U.S. government is still going to take in revenues. I think the real issue is that, you know, what bills are going to be paid and the short-term dislocations from those decisions caused by the failure to get something done, you know, if that does in fact occur before August 2nd. But my sense is that, you know, Treasury bills and bonds and notes are going to get paid if they mature. Interest will be paid, and other expenses may be deferred or delayed, but I don't foresee any major ramifications there.
Yeah, that's right. I think they've set up a $90 billion contingency fund to pay the interest on the Treasury bills. But what about the stripping of the AAA rating? Has that been priced into the markets?
Well, I think it has to some degree. I mean, clearly it's a negative, although I'm not sure what the long-term implications are going to be. To me, it's a little bit more maybe symbolic than maybe material. I mean, the reality is the U.S. deficit situation has been deteriorating for some time. Arguably, you could have downgraded the debt a long time ago. So, I'm not sure if this is the one event that really triggers it for everybody. And realistically, it's the market that determines value and whether Treasuries are still credit-worthy or not necessarily a rating agency. We saw in 2008 really what some of those rating agency ratings were worth, and so I think it's the marketplace. I mean, the result or at the end of the day, the United States dollar and Treasuries are still a relatively safe haven investment. There's an underlying economic engine underneath that currency. Property rights, private property rights are also here in the States. So, I mean, where do you go? I mean, so if the negative or the lack of a AAA rating bothers you, feel free to buy euros, Japanese yen, or some other emerging market currency if you so desire. But warts and all, I think the United States still has a lot going for it, even with a downgrade at this point.
That is very interesting, Michael, because corporate America is doing pretty well. We got numbers from Starbucks showing that Americans have enough cash to still buy their cappuccinos and their grande lattes, and you can throw that in with 75 or 77% of the companies have beat with their results so far.
Yeah, and I think, corporate earnings are one of the strengths in the United States economy and have been for several quarters. I mean, without corporate profits, I don't think you'd be talking recovery at all, really. And so a lot of U.S. firms are able to compete internationally. We've been, at Permanent Portfolio Funds, been big believers in the long-term global growth story, and that U.S. companies are benefiting from that. U.S. stocks are not really expensive, given that there's underlying profits supporting prices. Dividend yields are favorable, and there's a lot of liquidity on the sidelines potentially waiting to invest. And so I think the U.S. stock market's not a bad place to be to invest, even if you're concerned about Treasury securities, for example.
So are you using the summer, Michael, then to maybe pick up some bargains for the long term? If so, where?
Yeah, like I said, we like the U.S. market in general, so there's a variety of industries. Energy, commodities we still think are going to be strong given the global economy. U.S. multinationals in industrial areas, industrial industries are attractive. Real estate investment trusts in the United States have done pretty well, especially in the corporate office space. So there's a variety of industries we like. From a safety trade standpoint, we're big believers in the long-term gains in gold and silver, given worldwide monetary policy and to guard against potential uncertainty out there. And we still, in fact, do hold Treasuries and intend to hold Treasuries as a guard against deflation and delevering if that comes to pass as part of our overall portfolio strategy.
Yeah, we do have a slight inversion, though, of the short-term yields right now on Treasuries because of the impasse in D.C. But we'll see what happens this weekend. It doesn't seem that you're going to be sweating too much, Michael. Can't say the same for politicians. But thank you all the same for joining us this morning. Michael Cuggino joining us from Pacific Heights Asset Management.